welcome to each of you. Today we at Alexander & Haberman are honored to be hosting Mike Becker to present Taxes and Retirement, the second in our summer speaker series, which also includes Social Security planning, Roth Conversions, the power of zero, a tax planning strategy, and long-term care planning. As we get started, we want to say it's great for us to be with so many of you again. A special thanks to all at Alexander & Haberman who make this possible, including Caleb and Joshua, who did a ton of behind-the-scenes work, as well as Zena, Christian, Jackie, Nicole, and Beth. We want to extend a special welcome to those of you who are seeing us for the first time, and give a big thank you to those who invited you. As we get started, I just want to say a little more about where this came from. After working with clients to take care of their health insurance, Medicare, and group insurance needs, we found that more and more of our clients were asking about things that were impacting their decisions. Things like Social Security, when to retire, if they could retire, how to pay for things like long-term care or leave a legacy. While I briefly dabbled in financial advising, I no longer practice in many of these areas. Yet I still understand the impact they play in our clients' decisions and lives. Because we've partnered with many financial advisors for a long time, we look to those advisors to help us present information on these topics. Today's presentation, Taxes and Retirement, is presented by Mike Becker with Legacy Financial Partners. Mike Becker has been in the financial services industry for over 27 years. He started in the industry right off the college campus. After 6 years of running his financial planning business, he transitioned into sales management. The last 20-ish years, Mike was in frontline management in Bloomington, Minnesota. Mike has received numerous company and industry awards, and his branch was often recognized as the top branch within his company. In 2013, Mike was recognized by Finseca, known at the time as Gamma International, with the Brian Early Frontline Excellence Award. Mike has continued to be an active member in Finseca since joining in 2005. He's been a volunteer on Finseca's Recognition Committee and Gamma's Leaders of Today and Tomorrow Committee. In 2013, Mike was nominated to Gamma International's Board of Directors. In 2021, Mike decided to start a family financial planning business called Legacy Financial Partners, LLC. Legacy Financial Partners works with Securities America, Futurity First Insurance Group, and Senior Market Sales, providing his clients financial solutions. Mike specializes in building and implementing financial plans for busy families living in the Midwest, as well as helping retirees with their retirement income plans. When Mike is not working, he enjoys golf, Wisconsin Badger football, and thus a healthy rivalry with U of M alum Joshua, and chasing his 3 kids, all under age 11, around the house, the golf course, and ball fields. Mike has been married to his wonderful wife Anna for 13 years. Alexander & Haberman does not practice in the specialties of its speakers, so we welcome them here to speak for the educational benefit of our clients, friends, and guests. Alexander & Haberman is a specialty firm focused on assisting with Medicare Advantage, supplements, and Part D plans, as well as individual and family health insurance on and off exchange, and other benefits including health, dental, and vision. Now, to get us started with today's presentation, it is my honor to introduce Mike Becker.
Awesome. Thank you, Brittany, for that warm introduction. I'm excited to be here with you, Joshua, the Alexander & Haberman team, clients, friends, to be able to talk about this topic of taxes and retirement. It's interesting because it doesn't matter where I go in this country. If I walk into a room and start talking to people about how bad are taxes today, it just opens up a lot of emotion. And people say, oh, it's never been worse, it's terrible. Well, the reality, maybe it is, maybe it isn't. What are we going to do about it is the question. But nothing, in my opinion, riles people up more than this concept around taxes. Before we get into it, as Brittany said, this is the second in our summer series. So we've got several different workshops coming up, and we'll talk a little bit about those as we go through the workshop. Many of you who've seen our presentations in the past, specifically Social Security, know that we've been talking about Social Security, and my article got picked up here by over 250 news outlets the other day, and so this is exciting for us to know that this topic of Social Security is really important, and our story and message is getting out. So a little self-promotion, we appreciate that. Our disclaimer, we always mention that I'm not affiliated or endorsed by the federal government, Medicare system, Social Security system, or any other governmental program. I'm simply a local financial advisor that does what I can to help people navigate the landscape of their financial future. And as we really get in this concept around taxes, there's going to be lots of things that we're going to talk about. There's lots of milestone dates, and this slide came from our core retirement decisions last year. It's got lots of different dates of when you should think about things, and we're going to really weave a lot of these dates into today's conversation. And the topics that we have, as you can see on the screen, I don't know if anybody's going to be excited about these topics, but it's really interesting, right? It's really important that we really focus on learning about these because we have the opportunity to put our head in the sand and not worry about, not think about, not address these topics. Or, as y'all are doing today, is take the time to learn about these different topics and how you can navigate the tax system, not only today and in the future. And if you Google up tax quotes, there's some interesting stuff out there, and these are a few that I like. The first one said, "I'm proud to pay taxes in the United States. The only thing is I could be just as proud for half the money." I think we all probably feel that way maybe when we see how the government maybe spends our money. But again, it's a situation where we know that our tax dollars do go towards teachers, roads, and lots of other things. "I'm thankful for the taxes I pay. It means that I'm employed." That's really the appreciation mindset, right? So it's not a bad thing. It means that we are employed and generating income. The great philosopher Snoopy once said, "Dear IRS, I'm writing you to cancel my subscription. Please remove my name from your mailing list." That's probably how we all feel. By the way, don't do that. That might land you in jail if you do that. So please don't take Snoopy's advice. In this quote, I'm going to weave into today's conversation several times. Max Baucus is was the chairman of the Senate Committee on Finance. And what this member does, or this committee does, is really helps write the tax code. So it's arguably one of the most insightful of our Congressman Max Baucus. Anyway, what he said was tax complexity itself is a kind of tax. And we're going to talk about that today because it's the confusion where a lot of people just say, the heck with it. So I think that's really important what Max once said. Why do we talk about taxes right here? If you ever go on usnationaldebtclock.org, you can see a lot of numbers, but we are, as a country, $30 trillion in debt. Last year we did this presentation, we were $28 trillion. What happens just in 12 months? $30 trillion. Moreover, the bottom has what's called unfunded liabilities. What's an unfunded liability? It's a promise to pay. Social Security, it's a promise to pay me, it's a promise to pay you. Medicare, promise to pay us in the future. Those unfunded liabilities, those promise to pay in the future, is at $170 trillion. How do we pay for that? The interest on that debt, the tax system. And as I talk about these different topics, I often like to provide additional resources. If people want to learn more, dive deeper into the topics, these are the two that I like to recommend. The first one is by Mr. David Walker. David Walker is the former Comptroller General of the United States, basically the head CPA of this country. And I'd argue that that role probably knows more about the math and the numbers than anybody in this country. And David Walker wrote a book back in 2008 called Come Back America. And really he went on the rampage, if I could use that word, saying we are going to go broke as a country. And we got two options, though. We got a solution. We can either double tax rates today or cut expenses in half. Neither of those have happened in the last 14 or 15 years. So as that problem, we just continue to kick that can down the road. Very heavy in math, but really sets the tone for the potential problem. Or as, again, David Walker talked about, is tax rates need to double or need to certainly increase. The second book is called The Power of Zero. We're actually going to do a workshop on the power of zero in September. And this is really more around the strategies if we are concerned about tax rates going higher, like David Walker talked about. Mr. David McKnight in The Power of Zero talks about strategies today that can put you in a better position, potentially getting to the zero tax bracket. Because now as we really change and think about going into retirement, taxes are completely different in retirement. How we were taxed in our earning years is in many cases different from how we're taxed in the distribution years. And so as we really start to think about this, this is really confusing. And I've always heard it said, and this kind of ties back to the Max Baucus quote of tax complexity itself is kind of a tax, is there's a tax on the informed and a tax on the uninformed. And what that really tells us is if we take the time to learn a little bit about it, hopefully it puts us in a better position. Because I love this quote by Lisa Simpson. She says, schools don't teach us how to pay taxes because they don't know how to do it either. Right? Who's teaching us this stuff? Where are we learning these things? And that's hopefully what you'll do today is take a few things away. Because as we really start to take a look at retirement, it used to be called the retirement nest egg. We always talk about this concept of retirement nest eggs because we've got lots of different eggs in our basket, and that creates confusion. It creates more complexity in how we ultimately plan for retirement because at the end of the day, taxes is part of our plan in retirement. And the rules really change. And as we accumulate in our earning years, the visual, of course, is a mountain. We're going up the mountain. That's really accumulation land. We're trying to focus on gathering more assets. As we go down the mountain, which we call distribution land, income planning, the rules change. We don't care so much about assets. What we do care about is income. After-tax income, because after-tax income allows us to buy things. And so that is really what we are talking today is how do we influence our financial situation to give us a better shot of having more income in retirement. So we're going to go through some basic concepts as we start to go deeper into this concept of taxes in retirement. The first picture we have has 3 spigots. Think of those spigots are creating income or income's coming out of those spigots. And on the far left side has ordinary income. And ordinary income is most of the income we have. It's our employment income, it's pensions, it's qualified plan IRA distributions, interest on savings, those type of things. Those all fall into the ordinary income category or faucet. The middle faucet is tax favored, where it's just maybe a little bit better or a little bit more favorable from a tax perspective. And then on the right side is tax-free. And there's some different kinds of vehicles as well. And we are going to spend some time today talking about each of those faucets. Because navigating retirement has all kinds of things that we need to address. We need to think about Social Security and these concepts around pension and capital gains and required minimum distributions and Roth and deductions, on and on and on. It's a very confusing time. And people want to do one or two things, and that's absolutely fine, but we really need to take a look at many things as you plan for retirement. The first one that we're talking about today is talking about taxes. And if we talk about taxes, we have to start talking about the tax bracket. And what we see here is the tax bracket for a single person. And I'm going to jump to the tax bracket for married filing jointly. And there's a few things that I want to focus on this slide. The first thing I want to focus on is, number one, our tax system is a progressive tax system. What does that mean? It means as you make more money, you pay more of a share or higher percentage in tax. And so you can see on the table here is we have the rates, 10, 12, 22, 24, on and on. So again, as you make more money, you go into one of those tax brackets. The second thing is if I'm in a higher tax bracket, let's just say 32, it doesn't mean every dollar's taxed at 32. The progressive system says some of my dollars are taxed at 10%, some at 12, some at 22, you get the point. So Bill Gates has some of his money taxed at 10%. Even though it's only for about 2 seconds, some gets taxed at 10, some at 12, some at 22, and a whole bunch at 37. The third point that I think is really important on here is you see those arrows and this concept around bracket jumping. If we're doing tax planning, it's really important to understand where you are currently at and where the next bracket could potentially be. And those 2 arrows point out big jumps. So if we go from 12% to 22, that's almost 100% increase in tax rate. From 24 to 32 is over 30% increase in tax rate. So those are really important categories to know if you're doing tax planning where that next bracket jump potentially could come. And this concept is something that was taught to me many years ago, is this Becker concept. We remember Becker from chemistry class, maybe, is when you make money, it goes into the tax beaker and goes to the bottom, and again, parts tax at 10, then 12, et cetera, et cetera. So the next dollar that comes in goes into the tax beaker, and wherever it lands is where you are ultimately taxed. So this concept is around marginal tax rate. So it's the next dollar of income you make is taxed at one of those rates. So this marginal tax rate's a concept that we're going to really talk about today. Is next dollar of income, how is that taxed? Okay, so we've talked about some basics. So are we all confused? I think we're all confused. I like this little cartoon. It says, none of this makes any sense. It's almost if they don't want me to understand. And the gal on the right says, maybe that's why they call it the tax code. So if you're not wrapping your head around it at this point, you're like just about everybody else, that's okay. It is a complex concepts, or lots of complex concepts. Okay, so we talked about the first faucet on the left of ordinary income. The next faucet is tax favored. So it's taxed a little bit lighter, if you will. So we have probably heard the term capital gains. So as society, we motivate people, inspire people to invest back in our community. And by doing so, we get a slightly different tax break. So if we invest in properties or businesses and we sell those things and we have a gain, that's called a capital gain. So you can see the married file jointly, there's single as well, is if you're in the married filing jointly in the 10 or 12% tax bracket, your capital gains rate is 0. Not a bad deal. Now, if you're in the second category, so now you're sitting 22, 24%, 32, you're going to be taxed at 15. So again, you get a little bit of a tax break. So again, capital gains as we sit here today is slightly more favorable than ordinary income. What's challenging about the tax code is these hidden, I'll call them hidden interactions between income types. We're going to talk about a few of those, but it's these things where this income affects something else. I'm going to say this a lot, these hidden interactions, because I want to point out a few things that you might not see on your income tax today, but might hit you in the future. And one of those is Social Security. Now, we had a great workshop on Social Security last month, and we talked a little bit about the Social Security tax. So we spent a lot of time talking about this concept around provisional income. So there's a lot of confusion. Is my Social Security taxed? And it's either not taxed, some of it's taxed, or a bunch of it's taxed. So it really comes down to this term called provisional income. So we've all heard these different income types: gross income, net income, adjusted gross, modified adjusted gross, on and on and on of all these different types of income. Now we can add provisional income. It's a special, it was inserted in the tax code back in the early 80s, 30 years ago. And the same chart has not changed. So these numbers are not indexed for inflation. So what was put in the tax code many years ago, where very few people fell into this category, now many people do. And you can actually see these numbers. So the first category, if I can stay in the married filing jointly, the middle category, if your provisional income is under $32,000, then your Social Security or none of your Social Security is taxed. That's a really good deal. The second category says, well, if you're between $32,000 and $44,000 of provisional income, half of your Social Security is subject to tax. And if you make more than $44,000, then 85% of your Social Security is subject to tax. Now, it's subject to tax. It's not at a tax rate. So think about taking 85% of your Social Security and putting that into the tax beaker. But what that does say is it says that, yeah, part of your hard-earned Social Security dollars, you might be given back 15, 20% of those dollars in the form of your Social Security being taxed. So the question is, how do you figure out provisional income? So there's really three categories. The first category is we take half of the Social Security that's coming in, and basically everything else: your wages, your pensions, investment income, distributions from your qualified plans, IRAs, just about everything. Throw in any muni bond interest you have, and all that goes towards the calculation that we had earlier. And why is this important? Remember, these hidden interactions between income types. So let's just go through an example of where income comes in determines how much taxes you actually pay. So we're going to show two examples here. In the first example, you can see on the top it says this person has two sources of income. $20,000 is coming from IRA distributions, $40,000 is coming from Social Security. That's $60,000. Based on where that income is coming from, you can see the chart to the right or the tax, it says 0. So this particular person's paying 0 in tax. Well, if we take the same person and just flip those numbers, $40,000 from IRA, $20,000 from Social Security, it's the same $60,000, but now this person's paying $2,400 in taxes. It's not significant, but all these these hidden interactions start to come out. So again, where you get your money in retirement really determines and impacts what your tax rate is. Okay, so some of us have done a good job saving. Some of us haven't done a good job saving. I love this little quote. It says, this couple is talking to their accountant. The accountant says, no, you can't deduct what you spend on lottery tickets as retirement planning expenses. By the way, that's not an awesome strategy for planning for retirement. Use traditional investments. That's a better way of ensuring success in retirement. But if you do accumulate in those other buckets, the traditional IRA and 401k, those type of things, what we also need to understand is there's this tax time bomb that's coming down the pike. We've heard the term RMD, or required minimum distribution. So what happens is people put money into their IRA or 401k, and for the most part, they can't get that money out without a penalty before age 59 and a half. We've heard 59 and a half. So now when people look to pull money out of their IRA, they say, oh, I got to pull money out, and I put that into the tax beaker, meaning it's subject to ordinary income tax. There's a lot of people that say, well, I don't really want to pull money out of my IRA. So the IRS says no problem. Until you get to the age 72. It used to be 70 and a half. 72 is required minimum distribution based on the Secure Act change 2 years ago. And what that simply says with required minimum distribution is now you must pull money out of your IRAs. You don't have to, but if you don't, there's a 50% excise tax. So we'll talk about that in a second. So the IRS is very patient, the federal government's very patient, but eventually they want their money from your IRA accounts. And how do you calculate required minimum distribution? So you figure out what your balance was on 12/31 of last year. What was your balance on 12/31/2021? And then you'll find a life expectancy or an RMD factor, and you divide it, and that tells you how much it is. So it's really a pretty simple formula. And this is an example right here. There's a lot of numbers, but what I want to point out is this just simply shows somebody with $500,000 in an IRA. And what I want to focus on is the life expectancy factor, or the percent of the balance. So the factor is the divisor. The percent is really how much of your IRA you're pulling out. What's important about this isn't necessarily the numbers. It's what's happening as you get older. The percent of money in your IRA that you have to pull out continues to go up. That's how RMD works. So what do you do with the RMD, right? Because you have to take the money out. So now there's basically 4 things that people do with the money they pull out of RMD. The first thing they do is spend it, or they should do is spend it, right? The golf club membership, buy the boat, travel the world, do all those fun things. You've earned it, you've saved, spend it. Well, unfortunately, a lot of people don't do number 1 because their spending habits have been established. So what they do is they take that and they stuff it into another savings vehicle. Guess what that other savings vehicle is? It's a taxable account. What does that do? It generates more tax. That's what most people do. The third thing is a really smart decision is look at the funding things like insurance. Think things like long-term care. Pays out tax-free money if you need care. How about funding life insurance, which is a way better asset to pass on? It passes on tax-free. So some of those insurance products also provide tax-free distribution. Really smart strategy. Last strategy is a concept we shared during last year's core retirement decisions. And I want to spend a moment on this because if you are 70 and a half, you need to write this down. If you're 70 and a half, write down QCD, Qualified Charitable Distribution. This is really important. Essentially what this says is you can transfer money if you are charitably inclined. You can transfer money right from your IRA to your charity, don't pay tax. In addition to that, that transfer satisfies required minimum distribution. So let's just use this example for the next few slides. Your RMD, your required minimum distribution, is $20,000. Well, if you transfer over $15,000 to an IRA or to a charity, you've satisfied almost $20,000 of your required minimum distribution. So if you are charitably inclined, you absolutely, and you're 70 and a half, you absolutely need to think about the QCD, talk to your financial advisor, your accountant, or you can reach out to us for guidance as well. So let's talk about this time bomb that I talk about with required minimum distribution. Let's put some numbers behind this. As an analytic, I like to look at things mathematically. So we have our tax chart on the right side. So on the left side, it just shows somebody who's has $80,000 of taxable income. If we look at the chart, that puts them comfortably in the 12% tax bracket. Not so bad. But they happen to turn 72, and they have their required minimum distribution. And on that $500,000 or $511,000 IRA, their required minimum distribution is about $20,000. So they make their $80,000, that's what's in the tax speaker. They put another $20,000 in the tax speaker. Now, guess what happens? Look to the right and see, now they're making $100,000. So most of that RMD is taxed at what marginal tax rate? 22. So most of their RMDs is taxed at twice what their other dollars are taxed at. So this is that bracket jumping, the unintended consequence of doing a great job saving in your IRA, where ultimately it can start to really push you up into higher tax brackets. Let's finish up on RMDs because I think there's people that want to know a little more about RMDs. So as I said earlier, if you don't pull money out of your, or you don't take your RMDs, then you receive a 50% excise tax. It's the most punitive tax in the tax system currently. So take your money out if you are at that age. Now, if you pull the money out, or if you pull money over and above your required minimum distribution, that doesn't satisfy future years. So back to this 20,000, your RMD requirement is 20,000. You pull out 25, well, that extra 5,000 doesn't go towards next year. You still have your RMD to take next year. Now, as you pull that money out, it's taxed as ordinary income. Remember the spigot on the left, so it goes into the tax speaker, but you can withhold taxes so you don't have a giant tax bomb at the end of the year. Number 4 is whatever you paid last year in RMD is going to change. Why? Because the account balance is going to change and your factor is going to change. So don't just say I paid $20,000 last year, I'm going to take the same distribution this year. It's likely to be different. And the last question that comes up a lot of times is, what if I have a spouse? Can we just take it all out of my husband's account, right? Let's say husband has 20,000 RMD, wife has 20,000. You can't just go into the husband's and pull out 40. That satisfies the husband individual IRA. Wife still has an individual IRA with individual rules. She still is required to take out 20,000. A couple other questions that come up in this scenario is who's responsible for letting me know how much I need for my required minimum distribution? The answer to that is it's always your responsibility, but it's the custodian's job. The custodian is the Fidelity, the U.S. Bank, whoever holds your money. They typically will send you a letter saying, here's your account balance, and here is your required minimum distribution. And I think one thing that's really important is, what if you don't get that letter from U.S. Bank? Not picking on U.S. Bank, but what if you don't get that letter? Whose responsibility is it? It's your responsibility. I am amazed how often people don't change their address with their financial custodians. As a write down, make sure you are letting your financial services companies know that your address has changed. That's a really, really, really important deal. Okay. The other thing when we're talking about RMD is we're talking about this IRA. So again, people have done a great job of saving in their IRA. Hopefully they've spent it on the country club membership, the boat, and travel in the world. But what if they don't and there's something left over? Well, what's being passed on to the next generation? There's 3 things that are really important of how are the kids going to inherit the money. The first one is, some of you have heard this term called the stretch IRA. Well, if you are planning on doing the stretch IRA is no longer available, thank you to the Secure Act from 2 years ago. So if that was part of your strategy, reach back out to your financial advisor, accountant, custodian, make sure that you address that, but that's gone. The second thing is really important is update your beneficiaries. Again, I'm amazed how often people don't update beneficiaries, not just your primary beneficiary, but I'm talking about the contingent or secondary beneficiary. Make sure you don't have the estate or leave it blank. It just, by having proper beneficiaries, it just gives your kids more options when it comes to distribution. So it's really, really important to periodically do a beneficiary audit. Talk to your financial advisor. We can also help with that as well. Number 3 on the list is IRA gets passed on to the next generation. It is taxed to the kids as ordinary income. They too have their tax beaker. So anything they inherit goes right into their tax beaker. So let's go through an example, a mathematical example. So let's just say your daughter's family has a household income of $150,000 adjusted gross. Well, now they inherit $500,000. Where's that $500,000 go? Right into the tax beaker, right? Now what's happening? Now some's taxed at 24, some's taxed at 32, some's probably taxed at 35. On the federal side, throw in state on top of that. There's a likelihood that the kids are going to lose 40% of that. Now they're happy as a lark because guess what they're going to do with that money? They're going to join the country club, buy the boat, and travel the world, right? They're happy, but mom and dad are rolling over their grave saying, what could we have done differently to pay at a lower tax bracket or join the country club, bought the boat, or traveled the world? So now we're talking about something that can cut into your IRA, whether it's in your lifetime or the kid's lifetime. The next thing that's really important is what could destroy your IRA completely. What is the one thing that jumps out to me that I've seen overwhelmingly destroys IRAs every day is the cost of long-term care. And I wanted to put this in because I think this is really important as we're talking about our IRAs. There's 3 important numbers there. First and foremost, in today's dollars, semi-private rooms are over $11,000 per month. What's that going to be in 20, 25 years from now? $24,000, $25,000 per month, right? And utilization, how many people are utilizing home care assisted nursing homes? It's over half, and that number I just continue to see climbing. And think about that. If you had a $500,000 IRA at $11,000 per month, that hard-earned IRA, took your whole life to accumulate that, is gone in 44 months, right? So planning from a tax perspective is really important, but don't put your head in the sand when it comes to long-term care planning. We did a workshop last November. Feel free to let us know if you'd like that workshop. We also have a workshop coming up on long-term care in October, so make sure you get that on your calendar. So back to taxes. So what we really need is tax diversification. So this is what I see every day, is I see on the left side 2 different size bubbles. We got the little bubble, which is the tax-free money, and we got the big bubble, which is tax-deferred, IRA, 401k. Those are out of line. What we really want to see is we'd love to see a reverse. How nice would it be to have a big fat tax-free bubble and a smaller tax-deferred? Tax-deferred should still be in your portfolio. We would just like to see these bubbles a little more equal to give some tax diversification. So how do we do that? How do we really build that tax-free bucket? This concept I mentioned earlier is power of zero. I'm not going to spend a lot of time going through this today. We do have a workshop coming up in September on power of zero. And really the idea of power of zero is how do we get more money into that big fat tax-free bucket to give us more tax diversification? Because we know we have these hidden interactions that we're going to continue to talk about, that we really want to make sure that we've got a nice big tax-free bucket. And these are a couple examples here. I'm going to dive a little bit into the Roth categories, but again, in future workshops, we're going to talk about Roth conversion. We're going to talk about power of zero. We're going to go a little bit deeper into these concepts. So let's talk about Roth for just a moment. Roth has been around since about 1998, so it's still relatively new. So if you feel like why is my tax-free bucket so small? It's just because it hasn't been around as long as the tax-deferred bucket. So we know Roth potentially provides tax-free money. Potentially, it has to be in that account for 5 years to be fully tax-free. But this analogy, this concept of farming, of do you want to pay tax on the seed or the harvest? In a Roth IRA, you're paying tax on the seed, not paying tax on the harvest, and it's opposite in tax-deferred accounts. So that's, again, it's not a tax avoidance, it's a tax now strategy. Once taxes are paid they're behind you. And this concept I use all the time is I say when you are in tax deferred accounts, IRAs, 401ks, it's kind of like you're in a business partnership with the IRS. Although the IRS gets to vote each and every year on how much of your money they get to keep. So you've accumulated well in your IRA. It's really hard to do retirement planning because you don't know how much of that asset is yours. Because you don't know, unless you can accurately predict what is the exact tax bracket I'm going to be in when I take distributions. It's really hard to do retirement income planning when you don't know. When you know that the IRS is paid off and all of that money is yours, it's much easier. So getting the IRS out of your business and getting money into the tax-free vehicle makes a ton of sense. And then again, with these hidden interactions that we'll talk about here in just a minute, having tax-free money really puts you in a better position. Remember Social Security we talked about? What if we kept our income below that $32,000 number, right? Our Social Security could potentially be tax-free as well. So this really helps with those hidden interaction. So running through real quickly, the Roth IRA, there's a few things that are important that I want to point out is you can contribute $7,000 per person per year if you're over age 50. Now, that's sort of a slow way of doing it, but you and your spouse, if you have earnings, you can contribute at any age, and you can contribute up to $7,000 for you and $7,000 for your wife, or your spouse. Even if your spouse is not working, as long as the household makes over $14,000, you can contribute $14,700 and $7,000. Now, there are some earnings limitations. If you're single, the number's around $150,000. If you're married filing jointly, it's about $210,000. That just means if you're making over that amount of money, you can't do a traditional Roth IRA. There's concepts out there called the backdoor Roth. There's things that your financial advisor or we can help you do to potentially get money into the Roth. The number 2 category here would be Roth 401k. Now those are becoming more and more popular today. The Roth 401k hasn't been around a long time, so many of our 401ks now do have the option to contribute up to about $20,000 per year into Roth. That's a big deal. You can go a little bit faster into the Roth 401k, no earnings limitations. The third Roth option is the conversion. We actually have a workshop coming up in August specifically about the Roth conversion, but we'll touch on this real quickly. So what it is you're essentially converting from that IRA bucket into the tax-free bucket. It's not a tax avoidance strategy, it's a tax now because you know how much you have to pay in tax today. It's predictable. So it is a taxable event, right? Anything that you convert, you put into the tax beaker. That's why that bracket jumping concept is so important, understanding where you're at. There's no income or age restrictions. Bill Gates could do this. It is something that you can't reverse. So make sure you do talk to your financial advisor or your accountant before you actually do it. We can be a resource as well. Moving on to non-qualified assets. So I spent some time talking about this future tax time bomb in our IRAs and 401ks. Well, some of us have done a good job of investing and saving outside of 401k and IRA. We call that non-qualified assets. And so sometimes the funding vehicle is a mutual fund. And a mutual fund typically is a pass-through. And what that simply means is they're buying and selling inside that mutual fund. And if they sell gains, they push that through to us as consumers. No matter what the value of that mutual fund is done that year, if there's gains, that gets pushed out to us. And then we pay tax on that gain each and every year. So that's the mutual fund. Now, the question often comes up is, what's this tax loss harvesting concept? And I'm just going to stay with this at a high level. Essentially, and this is important now, that maybe some of our individual stocks or mutual funds are down a little bit. Let's just focus on maybe a stock. You bought a stock at this level, it's now worth less. If you sell that stock, there might be a loss. You can take that loss and put it on your taxes and offset any gains that you potentially have. So that can help mitigate losses, tax loss harvesting. And I should say, if you had a bigger loss than gain, you can carry $3,000 of that loss over every year. So that is really beneficial. If you do decide to sell some stocks today, then you can carry over and eliminate or wash some of those gains. Now, it is important before you do this, there's a wash sale rule that's out there, and the long and the short says, let's say you sold Apple stock, just to pick on a company, and you took that loss. And if you buy that same stock back within 30 days, it's likely the IRS will disallow that loss. So talk to your accountant, talk to your financial advisor before you move forward with that tax loss harvesting. The last point I want to talk about is most advisory accounts today. If you have enough money to do advisory investments, there are many strategists in the advisory platform that do this for us. They manage this inside the portfolio, and there's some really strong tax loss harvesting strategists that we have access to. Okay, the next part is the health insurance component. So again, we talked about these hidden interactions. Now, of course, if you're under 65, you want to talk to Alexander and Haberman about solutions. They are the experts around here. But what I want to point out here is when you're under 65 and you need health insurance, you buy health insurance. And there are potentially credits out there that go towards offsetting the cost. And the less money you make, the more the credit, or the less cost your health insurance is. Or maybe better said, if you make a lot more money, fewer credits, or your health insurance is more expensive. So you can call that a tax if you want, but what if you're able to keep your income really low when you need under 65 health insurance? That means you get a lot more credits and your health insurance is smaller. So again, hidden interactions between income types. And that also goes to over 65 as well. So over 65, you're going to go into Medicare. So we talk about Social Security. There's confusion around when you can start Social Security. Remember, Social Security has nothing to do with Medicare. Medicare is still, when you're turning 65, you're eligible for Medicare. Well, you have a Medicare cost, and you can see on the chart, based on your income level, determines what you pay. And you can see that married filing jointly in the middle, if you're under $182,000, your payment's about $170 per person per month. Well, what if you just go above that? You go into that next bracket. Now you have the privilege of paying $70 a month more per person. That's about over $800 a year times 2 spouses more in Medicare premiums. Now, call that a tax or not, I don't know, but remember, hidden interactions between types of income. Okay, moving along is this concept around income harvesting. I get this question all the time, is where should you pull money from? What type of account? How often, or what year should you pull it in, sort of the cadence of where you pull it out. And we're going to go through an example here right now, but what I want, hopefully your takeaway from today is, I'll call it by the book, right? What the book says, we'll go through the 4 steps and by the book. But hopefully your takeaway from today's conversation is, you're not by the book. Every situation is different. And so you really need to get inside and understand all these hidden interactions to really determine what is the best egg to crack. So let's go through a case example to illustrate this point. So we're going to go back through the same couple that we talked about earlier. This is Dennis and Karen, and they have 2 sources of income. They have that $40,000 coming in Social Security, and they have a little over $20,000 coming in ordinary income. So they have that a little over $60,000 of income. Well, now their daughter's getting married, so they need $20,000. So they're saying, okay, we need to pull $20,000 out of one of our accounts. Now, which asset should we harvest? So it comes down to, okay, should we harvest from the IRA bucket, or should we harvest from the capital gains bucket? So let's take a look at the example. So here's an example of pulling $25,000 out of their IRA. Well, in order to get $20,000 of income, they need to pull out $25,000. Or you can see that that red slice on the pies. They have to pay about $5,000 back in taxes. So you're going to delete that IRA faster because you're pulling out more to net $20,000. So that's sort of your example of pulling out of your IRA. Well, what if you want to just take it out of a non-qualified account? Well, you still have to pay taxes, but you're going to pay less. So now you only have to pull out $22,000 instead of $25,000. So you're paying about $2,000 back in taxes. You might say it's not that big of a deal, but could we mitigate that? Or again, how do we address the harvesting? And then the other part is maybe a blended strategy. Maybe you pull some out of your IRA and some out of your non-qualified bucket. This just shows a sort of in the middle, and this in the middle shows pulling out about $23,000 and having about $3,400 in taxes. So again, there's different strategies that you can use to determine how you should harvest. But boy, how nice would it have been to have a big old fat bucket of Roth money, right? That wouldn't have impacted their taxes a bit. But again, the traditional harvesting pattern, this is what the book says. It says maximize your Social Security first, because we know that is tax favored. Your non-qualified money, again, in many cases, it's going to be tax favored. Wait as long as you can to get into those IRAs, that RMD money. And then the last money you should pull out is the tax-free bucket. So again, that's by the book. But again, as I said, every situation's a little bit different. So what are some of the strategies that you can summarize from our conversation today? Is we've got 6 that we think are good strategies to look at. Number 1 is make sure you optimize Social Security. And as we said earlier, we do have a recording on Social Security. So if you're looking at how you should optimize Social Security, look for our workshop. You want to diversify. As I said, tax diversification. The more tax eggs you have in your basket just gives you more options. And as much as it feels like I pounded on the tax-deferred account, the IRA 401k, tax-deferred is still good. You just want to moderate what you're putting into that, or make sure you're taking advantage of other tax advantage vehicles. And then think about blending some of these strategies, especially with that IRA that's sitting there. Watch out, because at 72 is that RMD tax bomb. So think about being able to blend in and potentially pull some of that IRA money out a little earlier. And again, look for Roth IRA conversions and make sure you take advantage of our August workshop, and then leverage the use of insurance products, because those insurance products pay tax-free money, long-term care, life insurance, those type of things. So these are some great strategies. Now there's other strategies. I love this quote from Homer Simpson. He says, Marge, if anyone asks, you require 24-hour nursing care. Lisa, you're a clergyman. Maggie is 7 people, and Bart was wounded in Vietnam, right? There's different ways that you can, I guess, deal with the tax code. We don't necessarily recommend this strategy, but certainly it is an option for some. And as we get close to wrapping things up, again, I've really tried to weave in some of our future workshops, take advantage of our upcoming education workshops on Roth conversions in August, Power of Zero, tax planning strategies, long-term care in October, or any of our recordings. So let's map out the course. So as we go through these workshops, we often create more confusion. Why? Because there's a lot of information. So we want to make sure that we can help be a resource for you. So as you walk out of the workshop, maybe a little confused, hopefully we can provide some resources that can help you out. So some of those resources, we can do actually a tax report for you. You can learn how much tax you'll pay on your retirement account. This is actually one of our qualified account analysis reports, and you can see keeping money in qualified account and converting to Roth. Just an example of the type of report we can put together. We have a great white paper that talks about the new rules of retirement savings. It really gets us thinking about how we should be saving today versus what maybe mom and dad did 20, 30 years ago. And one of our most popular reports, we seem to always put this out there, is that complimentary Social Security timing report, right? When should I, in order to maximize my Social Security, when should I tap into those benefits? And again, if you want any of those resources, the best way to get those resources to go ahead and send me an email, and I'll leave that up there just for a second, and you can request any of the reports that we have right there. If you want a consultation or talk about any of these things, we're happy to do that and happy to be a resource as well. And I'll put up more of my contact information as well. So again, these are ways that you can reach us if you need us. And before we finish, I love this last quote. So if you feel like you're confused today, it's okay, because one of the smartest people on the planet has been, arguably, Albert Einstein. And he once said the hardest thing to understand in the world is income tax. So convoluted, confusing, probably going to get worse. Hopefully today gave you some maybe motivation to learn a little bit more about strategies that you can take advantage of. Because again, the tax code for the uninformed and the tax code for the informed, or as Max Block has talked about, tax complexity itself is kind of a tax. Thank you.
Thank you to everyone for attending Alexander and Haberman's Summer Speaker Series and today's presentation, Taxes and Retirement. Great thanks to Mike Becker with Legacy Financial Partners and all of our team, including Joshua and Caleb for setting everything up, Aaron for running today's technology, as well as Zena, Christian, Jackie, Nicole, and Beth. To request a recording of any of Alexander and Haberman's Summer Speaker Series workshops, email workshops@mnhealthagents.com. Alexander & Haberman is a specialty firm focused on assisting with Medicare Advantage, supplements, and Part D plans, as well as individual and family health insurance on and off exchange, and other benefits including health, dental, and vision. Thank you.